Today we are taking a look at USDT futures, perpetual swaps, part 2 of our tutorial, and we're focusing on risk management. Alright, so here's the outline. We'll talk about what risk management is, some facts about risk management, we'll talk about acceptable and unacceptable risk, we'll talk about the 5 possible outcomes of every trade, we'll talk about how to stop losses, we'll talk about why you should manage risk, and how to calculate your position size in order to make your trade within acceptable risk level. Alright, so let's get right onto it. What is risk management? I'm going to spare you all the BS theory. What you need to know as a trader is that risk is simply the amount that you would lose if a trade goes against you. Alright, risk is the amount that you can lose if a trade goes against you. And when you talk about proper risk management, it involves accepting risk wholeheartedly. This is more of a psychological, thing. You need to get to a point where you accept risk, and if you lose money, it doesn't really affect you so terribly. All right. Number 2, risking only a small percentage of your account, usually 1 to 5%. And number 3, having a good risk reward ratio. All right. So there are some facts we need to understand about trading. If you're a trader, if you're a newbie, you want to get into the game of trading, you need to understand that you will lose money. Now, this is one of the few things that is guaranteed in trading. As a matter of fact, it's not even guaranteed whether you make money. You can just enter any trade, you make money, but it's not guaranteed whether you make money in the long run. But it is guaranteed that you will lose money. All right. So what is very important that you know this and you understand it, and that's why you need to have risk management. Another interesting fact you need to know is that you cannot control the market. You cannot control when the market will move. You cannot control how the market will move. And the only thing you can control is yourself and your risk. And lack of proper risk management is the single most important factor why people eventually quit trading. Alright? If you give me 2 traders, I can tell which one is going to continue trading for a long term or which one is going to quit tomorrow by just asking them simple questions like, do you use stop loss? If you don't use stop loss, I know you're gonna get out of trading very soon. All right, so let's get in. So we have acceptable versus unacceptable risk. All right, acceptable risk is a risk that is planned. All right, you need to ask yourself a question like, how would I feel if I lose this trade? I've said it before. If you feel terrible, if you cannot stand it, then perhaps you shouldn't take that trade. You need to reduce your position size to a point where if you lose, it won't really break your heart. All right, nobody enjoys losing, nobody's happy losing, but if you're trading with an acceptable risk, you wouldn't feel bad. All right, you wouldn't feel terrible if you lose because it's part of the plan. Right, you need to plan for your losses. Right, because if you don't plan for your losses, the market is going to plan your losses for you. All right, now what would be the impact on me financially? Is it going to make me wrecked? Am I going to just lose everything I have if I lose this trade? If yes, then it's an unacceptable risk. All right, you want to make sure that you only trade when traded acceptable risk. That is a trade that will not have terrible impact on you financially. And then you need to ask yourself, what is the worst case scenario of my trading? Right, this is just like saying the same thing all over again, but it's very important. Right, what is the worst case scenario? What is the worst possible thing that can happen to you if you lose this trade? Are you going to lose your house? Is the police going to come? You need to imagine that thing has happened, and if it's something really bad that you don't want to happen, then that risk is not acceptable. You need to reduce your position size until you get to a point where the worst case scenario is bearable. Now, there are only 5 possible outcomes in trading. Is that you make a big win, a small win, a break even, a small loss, or a big loss. Now, if you can eliminate number 5, which is the big loss, then you can last long and win in the game of trading. All right, because these are things that you can't control when they happen. You can't control, like we learned that you can't control the market. All right, you can't predict the market even. All right, But we know that there's only 5 things that can happen. If you enter a trade today, no matter where you're entering from, no matter your technical analysis or fundamental analysis or whatever you're using, or your edge, is that you make a big win, a small win, a break even, a small loss, and a big loss. And all traders will go through these 5 possible outcomes. But if you're the trader that can eliminate the big loss, you will win. You get a series of small losses, you get break evens, you get small wins, you get big wins. All right, but you will still win in the long run, all right, because you've been able to avoid the big loss. If you look at the account of a winning trader, what you will see is something like this: small loss, break even, small loss, break even, big win, and that big win will cover up for the small losses, right? And then you have small loss, big win, and then small loss, big win, and then small loss, maybe 10 small losses and one big win. It's still okay, right? But if you look at the account of a losing trader, what you will see is small win, break even, small win, break even, small win, big loss. And that big loss, you know what it does? It eradicates all the small wins. All right, so you want to make sure that you avoid the big loss. And how can you avoid the big loss? Can you stop losses? No, you can't stop losses, but you can use stop loss. Now, what is stop loss? So stop loss is simply a tool in trading where when you enter a position, you kind of say, okay, for example, you enter a Bitcoin position and you feel, okay, I feel Bitcoin is going to get to where this blue line is. All right, so I enter right here and I want Bitcoin to get to where the blue line is. All right, so but if Bitcoin goes down, that means I'm losing money. You need to put a stop loss, right, in your trade, such that if Bitcoin gets below a certain a point, you get stopped out of the trade, right? You leave the trade because Bitcoin can keep going down, and then we've seen bear markets where Bitcoin just kept going down, and if you are in a trade in that scenario, you could lose a lot of money. All right, so stop loss is very important. You can't stop losses, but you can avoid the big loss, and the only way to avoid the big loss is to use stop loss. All right, now why stop loss? Why manage risk? It frees up your mental energy and capital to take on more opportunity. Now I want to show you guys another trade. Right, let's see CRV USDT. Now if you look at this trade, you will see that at one point the market was trending down and the market was just kept going down. Okay, let me expand the chart. Now if you look at this, the market just kept going down, and if you were the guy who bought at this point, where this green line is, I have a friend who bought here, and when the market kept going down, he was hoping that the market was going to go back up and then he's going to get out. He's not the kind of person that causes losses. It was tragic. All right, it was tragic. The guy lost a lot of money because the market just kept going down, and again, it's going to come back up. And then when he sees this small green, he will feel that, oh, this is the time, it's going to come back up, and then market will just keep going down again. And it was a really painful experience. Now, if you were in a long position, if you were buying this coin, and you didn't use stop loss at this point, by the time you got here, you would have lost so much money. You would have lost all your money. And you can see the market has actually not gone up. The market has actually not gone up to that point, to this point. All right, and it may never go up there. Who knows, right? So you can't predict the market. Anything can happen. So you want to make sure that you get stopped out of a trade that is not going out in your favor. Just accept a small loss instead of piling it up until it gets to a point where it becomes unbearable, where it becomes unacceptable. All right, so using stop loss, you can predict your loss. That's the beauty of it. You can predict your loss. You can say, for example, in this trade that I get into, I don't want to lose beyond $10. All right, so you make sure that you always construct your stop loss so that the worst case scenario for that trade is $10. And once you lose $10, you're like, okay, I'm good, I'm out, and then you look for the next trade. All right, that is how to play. You free up your mental energy and capital to take up more opportunity. Stop loss is the only tool that can guarantee you last long in the game of trading. It enables you to avoid the big loss, And like I said, markets can trend for a long time. If your trade is against the trend and you don't cut your loss quickly, it could be disastrous. All right. Now let us do a little practical. Let us practicalize this thing. Let us see how to calculate risk and how to place our stop loss within acceptable risk levels. All right. So the first step you need to know, first thing you need to do is you need to calculate your acceptable risk level based on your capital and your risk appetite. Every trader must have this. Every trader, you must calculate your acceptable risk level. You must know your acceptable risk level, and it shouldn't be something that you have to look at the paper. If I ask you what's your acceptable risk level, right, you should be able to tell me $100 or $200, right? And it is based on your capital and your risk appetite. All right. Now, generally, you want to risk only 1 to 5% of your account per trade. So if your account size is $10,000, that means your risk should be $100. All right. So that's 1% of that's 1% of $10,000. Am I right? Yeah. 1% of $10,000 is $100, and that should be your risk per trade. Right? If you are the kind of person that I have a lot of money, I have a lot of other businesses, and I can risk a lot. I don't mind. Your risk could be $500. All right, but it's a personal thing. It's something that you need to understand and accept. All right. Now that you know your acceptable risk, now the next thing you need to do is that once you're trading, you need to identify your stop loss based on technical analysis and fundamental analysis. And some people define stop loss as a point where you feel that a trade is going against you, and you feel that your reason for taking that trade has been invalidated, and you want to get out of that trade because you feel that trade is no longer what you thought. Let's say you bought Bitcoin hoping that everybody's buying Bitcoin, so you feel it's going to go up, but then trade started going down. If you have a stop loss, you can cut you out of that trade. Right? So let's do this. Let's say I want to buy this coin now, CRV USDT. All right, and I believe that this yellow line here is a very important support area. Let's move it up a little. Okay, let's say I feel this point is a very important support area, and if price goes below it, it's going to keep going down. All right, so I want to put this point where this yellow line is as my stop loss. All right, and then I'm buying at this point where this red line is. All right, I'm buying at this point. I'm buying at the market price. All right, and then maybe I can put my take profit above that. I'm not going to talk much about take profit, right, because it's not within the scope of this video. We're talking about losses here. All right, so now, so you need to calculate. What you want to calculate is how much CRV should I trade such that if this trade goes against me, the worst case scenario is that I only lose $100. Now, remember that in our video, in our example, we said that for someone with a $10,000 account, the risk could be $100. All right, so let's take $100 as our risk as an example. All right, so I want to make sure that I only lose $100. Right, so you come here, you look at the price. 0.58 is your market price. 0.568 is your stop loss price. All right, so you use your calculator. There are many online calculators. Most exchanges, Binance has a calculator that you can use. You enter your entry price 0. Let's look at that again. Entry price is 0.58. Stop loss price is 0.568. Entry price 0.58. Stop loss price is 0.568. Right. Let's just enter a random figure. Right. 10,000 CRV. Let's see what that would bring. All right. Now 10,000 CRV. If I'm trading 10,000 CRV, now this 10,000 CRV is I just came up with it. All right. You can just experiment until you get to your acceptable risk level. Now, if I'm trading 10,000 CRV, all right, and the trade gets my exit price, which is my stop loss price, is hit, the P&L, profit and loss, would be $120. So $120 is slightly above my acceptable risk level. I can't lose that in a trade, right? So what I'll do is that I'm going to reduce the size of CRV that I trade. All right, so let's try $9,000 and see if it's good. 9,000 CRV. Right. 9,000 CRV is 108 USDT. Right. No, I still feel I want to stick to my risk, because I just don't want to lose more than $100. Okay, 96 USDT. That's good. It's an acceptable risk. So I can go with this. So that means I can trade 8,000 CRV in this trade, and I can trade 8,000 CRV in this trade, and if it goes against me, I only lose like $6. It's within my acceptable risk level, and I'm cool with it. All right. So it is your acceptable risk level that determines your position size. All right. So that's you need to have that so you can calculate your position size, right? Because if you trade with too much position size, it's the risk may not be acceptable. If you lose like $1,000 in your trade and you only have $10,000 in your account, that's 10% of your money, and it could be very, very terrible for you emotionally and financially. All right. So that is basically how to calculate your position size and your risk, and put your stop loss within acceptable risk level. All right. So number one, calculate your acceptable risk based on your capital and risk appetite. Identify your stop loss position based on technical analysis or fundamental analysis. FA is fundamental analysis, TA is technical analysis. Use a calculator and your entry and stop loss positions to determine your position size. Adjust your position size until your potential loss is within your acceptable risk level. All right. So I think an appropriate heading for this section is how to calculate your risk and place your stop loss within acceptable risk level. All right. Or you can say how to calculate your position size. All right. So that is that. So I want to give you this practical. All right. What would be my position size if I have a $1,000 account and an acceptable risk of $50? Assuming I want to trade Bitcoin using the following signals. All right, you can see it on the screen. So this is a very practical exercise for you. You can do it and leave your answer in the comments of this video. All right. So that's it, guys. Let's do a quick recap. Proper risk management in trading involves accepting your risk wholeheartedly and risking only a small percentage of your account. You can't stop loss from happening, but you can avoid the big loss by using what? Stop loss. Risk management is the only way to last long in this game for the long haul. All right. Thank you very much for watching. I invite you to join the EME Trading community, where you can network with top traders, you can get technical analysis and fundamental analysis for your trades. You can gain access to premium signals and other exclusive benefits. All right, just follow this link bit.ly/EME Trading Academy, register and take your trading to the next level. All right, thank you very much for watching. Once again, my name is Tuju.